let's start with your first.
Right.
Oh, Steve,
chart.
the first one.
Fed pauses the hike, signals more what?
Well, you see, there's a lot of red squiggles, and there's blue squiggles, there's more blue squiggles, and I don't. Oh, yeah, right. Okay. Anyway, so the Fed increased interest rates, 10th consecutive meeting that it's done that. I don't think it ever did that before. And you can see the pace of increases compared to all the other previous tightening cycles for the last 40 years. This has been the steepest, the fastest, because we obviously know that we have an inflation problem. We have to deal with it. So what did the Fed also say yesterday? As you said, Mika used both the words skip and pause. And it was interesting because Jay Powell also used the word skip, and then he corrected himself and said pause, because he didn't want to commit himself to another interest rate increase. But in fact, the Fed did raise its projections for interest rates for this year from 5% to 5.5% at the end of the year, implying 2 more increases this year. And that's because the Fed also said yesterday the economy has been a bit stronger than we thought. They raised their forecast for economic growth to 1% this year, not a huge number, but a positive number. And they raised their unemployment rate, lowered their unemployment rate, and slightly raised their inflation rate. And then going out, you can see they raised their interest rate forecast for the rest of the year. This is the market. The market is slightly more optimistic than the Fed. It thinks the rate will actually end the year at 5%. And then continue to decline from there. So that's the outlook for interest rates at the moment.
So, Steve, let's talk about what's been happening. It has been easing, but again, everybody extraordinarily cautious, even you with your chart on, Willie, what did you call that wall?
That's the green monster of cable news.
Yes,
it's an iconic wall. Yes,
exactly. You know, we seriously, the next time he comes, I'm serious. You can pitch or I can pitch, but before he comes out, we got to play some wiffle ball against the Southwest wall.
Oh God!
So even on your Fenway, even on the green monster, you talk about it's slowly easing. Nobody's ready to say inflation's over, are they?
Nobody's ready to say that. But by the way, I think this has to be the biggest wall in the business, right? Nobody else has a wall.
No, you've got it. It's all yours. You own it.
Mr. Rat.
My friends at CNBC must be very, very jealous. But in any
they
event,
are.
Wow. So yeah, look, inflation is the key to this, obviously. The Fed does not want to raise rates more than it has to, and it's watching inflation very carefully. We did have some decent news on inflation a couple of days ago, which showed inflation continuing to come down. This is what we call headline, the overall inflation rate. And you can see we went up the mountain, and we're coming back down the mountain, and that's really good news. We're all the way back to where we were in the early part of 2021. And so that's the positive side. What the Fed likes to look at is something called core services, meaning the real heart of the economy. When you take out food, you take out energy, you take out a lot of stuff that moves around. What is the core doing? And that's because it's driven by labor costs, which we'll get to. And core of the news isn't quite as good. It's a little bit squigglier. We went up, we've come down, but we're sitting here at above 4%. And that is obviously a good ways away from the Fed's 2% target. And so the Fed still has a fair amount of work to do.
Well, you know, and obviously this economy has just been extraordinarily resilient, especially when it comes to jobs, when it comes to wages. What's that looking like? What's your third chart tell us?
That's really the point, Joe. The economy really has motored on in a way that I don't think many of us expected it would continue to do. And so what the Fed is watching really and what is going to drive this inflation are really two things. One is going to be wages, as we talked about. Look, normally we want wages to go up. We obviously want workers to earn more. We want them to have better lives. But if it creates inflation, it's counterproductive because then their purchasing power goes away. So wages, we're sitting back down here through most of 2015 and so on at a very appropriate level for 2% inflation. But then, of course, during COVID, post-COVID, with the employment surge, with all the spending and with the inflation, wage rates jumped up to over 5.5%. They've started to come down, but they're still above 5%. And they really need to get back down here in order for us to have that 2% inflation that the Fed is so targeted on. The other thing that's been keeping inflation reasonably high is companies' pricing. Companies in this kind of a strong economy have a lot of pricing power. They're able to pass these costs through, which also contributes to prices. And so you see what's happened to corporate profits. Corporate profits took off post the pandemic. Interestingly enough, $3 trillion of corporate profits. Even if you adjust for inflation, corporate profits are still bouncing around a kind of record level. And because of, again, the strength of the economy, companies have the ability to pass the cost through, and that also helps keep the inflation rate down. So we need to see a bit more competition on the pricing side.